Contrary to popular belief, most people in the United States can become somewhat financially independent if they use a slow and steady approach using dollar cost averaging. And I think that a big issue that a lot of people have fallen into, especially in the last 20 years with social media and Instagram and info products and digital courses, is people think that they can get rich quickly by trying different types of businesses. And all that leads to is a lot of shiny object syndrome. People trying one thing, getting a course, trying something, it not working, and they jump to the next thing because somebody else is selling something that will get them there faster. And there's a couple problems with that. One is that a lot of people have been sold the idea of making money very quickly, which is extremely difficult and requires a great skill set and experience building those skills, and an inflated idea of what it means to actually be financially independent. Most people think that they couldn't be financially independent unless they were sitting on millions of dollars. And they always say millions, they never actually quantify the amount. Realistically, for most people, financial independence can be as simple as, or financial independence is as simple as not having a crazy amount of debt, consumer debt, right? So we're not including like mortgages and stuff like that, but not having an insane amount of consumer debt, having enough finances to cover your expenses on a recurring basis. So your earned income exceeds your burn rate each month. And to hit a point of financial independence, you don't need to have so much money that you would never have to worry about it again. What you need to have is an amount of money that you would be comfortable with in the event that you experience a job loss or a shift in your earned income, and overall just generally not having to worry about money for, let's say, 6 months. Ideally there should be a safety fund, but if you don't have to worry about income for a year because you have that much saved up, then you're relatively financially independent, and from there you can keep building and growing. And the truth is that if you try to make money quickly, it's not gonna, like, money that comes in quickly goes quickly. And unless you have the skills and the experience and you know what you're doing in terms of business or trading or real estate or whatever it is, you're not really going to make a lot of money quickly. Most people struggle for a long time and they're learning the ropes before a lot of money starts coming in. And a big problem in the US is that people overlook something that isn't flashy, something that isn't quick, and something that doesn't give them instant gratification. And the truth of the matter is, if more and more people were to take some of the money that they have and simply dollar cost average, which is investing a set amount weekly or monthly into an asset, like into a stock, into the stock market, they could actually build a good amount of wealth in the long run. And to show you how simple it is, I ran some calculations, and you don't have to take my word for it. You can just Google DCA calculator or dollar cost averaging calculator, and you could put in whichever tickers you're thinking about, whichever stock symbols or companies you're looking at over a certain period of time. And you can put in an initial investment and then a weekly or monthly contribution and see what it comes out to. So if you do this with the S&P 500, you can see how impactful a small amount of money can be over a long period of time. So to look realistically at that, if somebody had started in January of 2010 and they invested $1,000 initially and then contributed $100 a week to the S&P 500, and they did that from January 2010 to December of 2020, so a little over 10 years, $1,000 initial investment plus $100 a week would leave you at the end of December of 2020 with $129,000. Now, if you extended that and kept going until December of 2025, you would actually have $257,000. So I believe that is a little bit less than double in the last 5 years. Now, that amount of money might not seem like a crazy high amount, and you might think, well, that doesn't cover everything, or I'm not financially independent. Maybe, but the vast majority of people can probably spare that. And the reason I use $100 a week is because obviously your income can go up and down as you move up into a different position or you grow within a company. So I'm using that as an average because maybe you start with 50 a week or 20 a week, but then over time you're able to increase it. And if it averages out to $100 a week, in 10 years, you could have gotten to $129,000. And if you went 15 years, you could be at $257,000, which is a pretty substantial amount of money to have in cash. And if you have no debts, no consumer debt, you're in a pretty good spot overall because the vast majority of people are living paycheck to paycheck. And to show you how powerful it is in terms of compounding, if you take that same time period, January 2010 to December 2020, you start with $1,000 initial investment and then $150 a week, you actually end up in December 2020 with $192,000, which is significantly higher than the $129,000 if you did $100 a week. Now what's crazy is that if you expand the $150 a week contribution out 5 more years to December 2025, your account would actually grow to $383,000. Now, this seems like a crazy amount, but if you look at the effect of compounding over a long period of time, you see that you see how powerful it can be, especially with how much growth the market has seen in the last 5 years. And the funny thing is, going back to December 2010, we were coming out of the Great Recession. Things were pretty rough for a while, and despite all of the ups and downs that we saw, the market still returned a significant amount over time. The dollar cost averaging over this timeline that I did takes into account all the big dips that came, including anything that happened in the 2010s and also the COVID drop and then the recent drop in 2025 with all the tariffs. So despite all of that, you would still be up a significant amount of money. And for most people, $129,000 or $192,000 in December of 2020 would be a significant chunk and would cover the vast majority of their expenses, given that they don't lifestyle creep and start spending more just because they have more. And if you fast forward out to December 2025, imagine having $257,000 or $383,000 at that point in time. Having that much in cash without having a lot of consumer debt, with having a stable job or even having some kind of income that helps you cover your regular expenses puts you in a much better position overall. That puts you in a position where if worst comes to worst and your burn rate is $5,000 a month, you are covered for well over 10 years. Or not 10 years, sorry, you're covered for well over 5 years if you don't ever find another source of income, which would be the case. You would definitely have some way of making money. But it goes to show that if you do a small amount over a long period of time, so much so that you don't even have to think about it and you can continuously contribute to something as simple as the stock market and the S&P 500, you can do very well for yourself. The only thing is, it's not a very sexy formula. It's not something flashy. It's not something big that a lot of people want to do because it doesn't seem very exciting. It's just a set it and forget it mindset. And then over a long enough period of time, you see that you've built a significant nest egg. And the great thing about stocks and brokerages nowadays is that you can pull the money out whenever you want, and you might not have to pull all of it out at once, right? But if you needed some money or if you had an expense come up, you could sell $5,000 worth or $10,000 worth and have it in your bank account within a day or two. So it's not that the money is illiquid, and it's not that the money is hard to get to or anything like that. It's something that would be available to you when you needed it, and it would grow over time, right? There's not a single savings account or bank that will pay you enough interest so that you would make the same amount of money. Nothing else has this kind of return. There's very few stocks that have this kind of return too. The market always outperforms everything over a long enough time period. And this is just a very simple one for the S&P 500. If you looked at other companies like tech companies and you added those into the mix, you would see an even bigger rate of growth because tech companies will go up and down and swing like crazy. So if you add more when they're down and it's a stable company like Google or Apple or Facebook or a company like Walmart or Amazon, you can see even more outsized returns. So I think that the vast majority of people in the United States and probably in other parts of the world following this strategy can make a pretty significant, can see pretty significant growth in their portfolio in a way where they don't actually have to do much. You don't have to think about it. You can trust in the market that the market will go up and it'll recover from dips and crashes and losses as we've seen. And I know with the way things are right now, we're expected to probably see a downturn or a retrace. And the funny thing is that people always talk about doomsday when things start to go down, but everything gets priced into the market. Even something as crazy as war or some kind of mass terrorist attack, these things get priced in, and the market expects things like that to happen, as sad as that is, so it doesn't have as crazy swings when something like that does happen. Now that COVID happened, pandemics and things of that sort will also probably be priced in. If there was another situation like COVID, even at a smaller degree, the market would not react the same. The market would have a much softer response to it, because that's just how these things work. The markets are designed to operate like that. So I think that it's a very important lesson for most people to understand, and it's never too late to start investing, right? Like, you might not have it right now. I'd say most people probably haven't done this, but if you start now, you could be in a much better position in 5 years, and an even better position in 10 years. And I think the very important thing to understand when you talk about financial independence is you have to define it for yourself. What does financial independence mean? What does it mean for you to be financially independent? And I think the way to do that is to have very specific numbers for yourself, to understand your monthly burn rate as an individual or as a family, as a household, to understand what dollar amount you could get to where you would feel financially stable, and having a specific amount, and understanding that it doesn't necessarily need to be millions and millions of dollars. And the thing is that as you contribute and keep growing these amounts, they start to grow very rapidly as you get more and more in there. Warren Buffett said, or not Warren Buffett, Charlie Munger said the first 100,000 is the hardest. But once you get to that, the money starts working on itself. The money, like, you're essentially paying into your account up until you hit 100,000. And once you hit 100,000, that money is starting to pay you and work for you. So this is something to consider and something to look into. I would recommend doing your own due diligence and understanding how markets work and understanding how you can invest safely into them. And as you do that, you find that there's a lot of other instruments and models you can use and make a blend of a portfolio that is much safer and is poised for growth and could even pay dividends. So you have basically free money coming in on a monthly or quarterly basis, depending on which dividend stocks you invest in. But the main thing is financial independence is not that far out of reach for most people. It takes a while, but realistically, I think the vast majority of people can look over the last 5 or 10 years and realize that $100 a week is not a crazy amount that they could not have invested, because most people spend $100 a week by the end of the year. You've spent that money on something else. So hold yourself back on some things, put that money into an account that invests in the market and grows, and you can get yourself to a point where you're financially independent in a relatively short amount of time over the long run, 5 or 10 years, or even 15 years. And it's something that seems long, but the thing is that if you're sitting at 30 and you're thinking, well, I don't want to wait 15 years, and you don't do this, and you don't see any other kind of major opportunities or chances to save the money that you're making, you might end up at 45 wishing, well, I wish I had done this when I was 30, because then at least at this point I would have however much money a dollar cost averaging plan would have resulted in if you had just done it. So you can think of a small amount that would not impact your life and still be able to enjoy your life, but have this thing building on the side. I think that's something that most people would benefit from, and it can turn a lot of people's lives around. And the thing is that even if you don't reach financial independence with the numbers that I shared, I'm sure you would still rather have that money invested in an account as opposed to not having it, because it would still get you closer to financial independence, whatever that means for you. So I would highly recommend looking into that. I think that financial independence is not far away for most people. It's just something that, unless you are going to work very, very hard in something, in a business, or develop skills where you can get paid a lot of money for and put a lot of effort in, for free initially, then you can, and if you're not going to do those things to make a lot of money in a short amount of time, you can make a decent chunk of money over the long period by essentially doing something that's completely on autopilot. And I think the vast majority of people are in situations where something like this is possible, and it would greatly improve the trajectory of their life and help them become financially independent.